We are back. Our breaking coverage of the Bank of Canada's rate decision continues. If you're just joining us, the bank maintaining its rate at 5%, the highest level that we've seen in this country since 2001, and adding a new sentence in its statement today. And that's all we're going to get. But the new sentence is that the data and indicators for fourth quarter suggest the economy is no longer in excess demand. Now, while that's a new statement, it's not necessarily new from the Bank of Canada, because a few weeks ago, we had Bank of Canada Governor Tiff Macklem in a speech essentially say that same thing. And so the reaction in the currency market, the reaction in the bond market is pretty muted. And it's interesting that we are getting this at a time where we have seen rates rally tremendously. So those yields, both in Canada and the United States, have come off as the market bets, once again, that central banks around the world are likely to cool their jets at these levels. We have been discussing this with Earl Davis, Allison of PIMCO. Earl, are you surprised that we didn't get the bank kind of hitting back more forcefully against the market pricing?
No, and part of the reason why, they'll let the markets do what they do in a range. But the interesting thing with this rally in bond levels is that it has a direct impact on mortgage rates. So let's call it an 80 basis points rally since the end of October, since the FOMC statement. That means your mortgage renewal rates are going to be somewhere, depending on the term, between, it's not going to be 1 for 1, but 50 to 80 basis points lower than they would have been a month ago. And that is significant in regards to the stimulative effect on the economy to help individuals roll over their mortgage for another 5 years. And I think that's part of the reason why they didn't want to forcefully push back on that rally. One other thing is that the central bank can only really control overnight rates. So they want the overnight rates where they are. They're not going higher, and that's what they speak to. They're not going to speak to the longer dated part of the year.
I do want to talk about, though, that because you're right, the Canadian mortgage market is priced off of that 5-year bond. If we could show our viewers what it has done. I saw a mortgage broker on Twitter say they were just able to get for their clients a 4.9% rate. And he went out and he acknowledged this was a special situation. Certainly the banks are not doling this out, but it is happening. Is there a risk, Earl, of this reacceleration in the part of the market that the bank is really trying to cool down the most?
Yes, there definitely is a risk. And that is why I think they added their last sentence that you mentioned previously. They're well aware of what happened last time they said they were on hold. Beginning of this year.
Right, February,
yeah.
This reacceleration.
Exactly. So they want to be on that long-term hold, but they don't want to get the market thinking the next move is an ease. It's literally a long-term hold, which is why we believe the easing cycle starts in Q3, late Q3 probably, and not Q2.
And Allison, in some ways, Canada obviously is a lot more interest rate sensitive than the U.S., and yet we are expecting kind of a similar tone and outcome from the Federal Reserve. How are you thinking about that?
Yeah, so I think next week's Fed meeting, in a lot of ways, I agree with you, is similar to what we saw from the Bank of Canada. We expect the Fed to stay on hold, and we think they also are sort of facing this balancing act. There's been some more limited signs of slowing in the U.S. economy, and the Fed is just trying to make sure that financial conditions stay tight enough, that they stay on course with restrictive monetary policy while they wait for more data and see how the economy evolves in the coming months.
What is your sense? We talk about cuts, and that gets everybody kind of excited. I detected a little bit of fear in the equity markets, certainly yesterday, where it's like, wait a minute, the bond market's really rallying. What is it trying to tell us about, the recession risk that is out there? At what point is the rally in the bond market, Earl, not bullish for stocks?
That's a great question. I would say the rally is not bullish for stocks once we see the numbers reaffirm what bonds are doing. Bonds always get ahead of the market, and more often than not, they are right. They are correct. But the actual data has to reaffirm that. That's why the Q1 is going to be such an important quarter, both in Canada and the U.S., to see where those numbers come out. And it's not just a decline. We're expecting a decline after all this hikes. It's the pace of decline. And that's what we'll be looking for in Q1.
Earl, I get the sense, your conviction was very high last year about how things were going to play out. Mm-hmm. It sounds like this time we've done a lot of work on inflation, that you're taking a little bit more of a data-dependent approach?
Yeah, and part of the reason why is we did anticipate this rally, but not now. We thought this rally would be a 2024 rally, not a 2023 rally. So given that, and you know,
In bonds,
given that, we do believe we're in a higher secular interest rate environment. Even if they do start easing, it's not going back to zero. It's going to stop somewhere above zero, which is important
what
to
is
know.
that number? Do you have the magic number?
You know what? I think it could go as low as 3%, right? Which is 200 basis points of rally by the end of 2025. I think that's a possibility. But I think that would be the lows, right? Otherwise, it starts stimulating inflation again. So because of that, and given how much the market's discounting now, we think the market maybe got a little bit ahead of itself. We're at the lower end of the range. We could stay here for a very long time. But you just have to be aware of that.
Allison, what's your number? What do you think that is kind of cuts, but not as much, obviously, not down to zero?
Yeah, we've been saying, normally what happens when you have a cutting cycle is central banks, we say, go down the elevator. They tend to cut rates very rapidly in the face of recession. And we think, both for the Fed and the Bank of Canada, it could look more like going down the stairs, at least for a little while initially. The banks are going to be a little bit cautious when they start the cutting cycle, just given what's been going on with inflation.
Allison, thanks.